how do you see economic growth? How do you see the markets behaving in 2021? Maybe we'll start with Alan and get your thoughts.
I don't think this is going to be that simple a forecast.
True, that is true.
I think it's going to be really difficult. It's like driving, but all you have is the rearview mirror.
Mm-hmm.
Let me just basically say, I have a frog in my throat, and he knows more than I. Also had a very significant increase in social benefits. And this goes, it's not only the United States, it's the whole world, including China, of all places. Looking for the economic outlook, it would be very interesting and very simple if we did not have the virus. It has fundamentally thrown off the whole sequence of patterns, as you can see what the data are here.
To translate that into the question about what do we see for the next year, the coming year, I think it looks to me like a year of two halves. The first half, and maybe I'm more pessimistic than Alan here, but I think it's probably going to take 6 months before we really get the vaccines thoroughly spread to our populations in the US and Europe, in the advanced economies, such that we can open up some of the borders between us. But then I hope it'll be a real bounce back and a pent-up demand.
You sound the way I do. I'm not that much more enthusiastic about the future. It's going to be a very rough adjustment.
I like the notion of a frog in my throat, and I'm as uncertain as the frog. I think that's great. We're all dealing with a tremendous amount of uncertainty here. I will say, however, that when you think about it, go back to the beginning of, when people were making macro projections at the beginning of the pandemic, what they said clearly over and over again, every forecast, it all depends upon the timing and effectiveness of the virus containment. And there may be a serious second wave. So actually the pattern we've seen, certainly in the US, is we had enough fiscal and monetary stimulus, unprecedented amount, that we got through that first phase really quite well. Then that started to die out. The stimulus is dying out, and the virus is taking off again. We're in the second wave. So that is a terrible situation and is likely to persist for several months. And then you have the uncertainty of you don't know exactly when. I hear all of these estimates. When will 50% of the population have access to the vaccine? Is it March? Is it July? Is it September? I don't think we know. So basically the second wave and the effects on the macro economy, unless offset by another round of significant stimulus, I think are really quite negative for the US economy. Now, I would be interested in what the voices from Europe have to say about there's more room, I think, for fiscal action perhaps in Europe. There may be more room for monetary action. The Fed has pretty much said they're kind of done everything they can do. They're going to keep rates low, and that's it. So a lot depends here on the speed of getting the vaccine and what kind of stimulus in the short run, let's say the next 6 months, is offered in the advanced industrial countries.
I agree with a lot of what Laura said, and I also think we have been making a lot of these points in our weekly letters, which has been another innovation during another of Afsane's innovations during COVID. I guess I would just make a couple of points. First of all, I think we have a terrific and experienced, knowledgeable team coming in. Secondly, they will be faced, as Laura says, potentially with a very difficult Congress. The third thing is, you're absolutely right about the unevenness. And one of the most striking, unexpected things perhaps this year has been the disconnect between what's happened in financial markets and what's happened in the real economy. And that is continuing. And some people have said, you know, that was an early puzzle, and then many people said, well, there's been an absolutely massive monetary policy push, as well as a very big fiscal push early in the year in the United States in March. And so it's not so surprising, financial markets looking ahead, and, you know, lower interest rates, discount future earnings, and so on. But I think now it's beginning to look more like a usual cyclical recovery in financial markets. But I think this disconnect is something that that worsens the concerns about unevenness and puts a higher premium on the importance of trying to do things to make sure that unemployment comes down quickly, that wages are, you know, have some support, and that we mend some of the holes in our own safety net in the United States, as well as encouraging Europe to have a more sort of forthcoming response in the coming period.
Caroline, if I'm right, I think usually after the recessions, there's been a decrease in employment and enhanced productivity, because not everybody who gets laid off comes back in. This is a different cause, but I'm wondering whether you think, or whether you've given some thought to whether we should expect, again, a productivity increase, in the sense that not all the workers, even in the service industry, where there can be productivity increases, not all the workers will be called back because people have figured out other ways of doing things.
I think that there is a pretty strong support for a kind of macroeconomic policy that will reduce unemployment more quickly than might have been the case in previous recessions. You know, we have to see if that's possible. I would love to hear Liaquat on the market real economy disconnect, or connect it for us.
Absolutely, connect it, please, Liaquat.
So I think the positive surprises have been corporate earnings, and they continue. They were surprising in the third quarter. I think there'll be a surprise in the fourth quarter, and it's perfectly consistent with this view that we are getting this big productivity increase. Secondly, the combination of whatever 20% GDP fiscal stimulus and $4 trillion in the Fed balance sheet expansion is, I think, massively bullish for financial markets. And the astounding thing is, a lot of this money is still sitting on people's balance sheets. We had pay down of debt. M2 went up by whatever, 25%. It's sitting in people's bank accounts. Now, I grant you, the distributional effects are not equal. And, you know, all of the people who got laid off from, you know, poor paying service jobs aren't holding massive cash balances, but a lot of us are. So I actually think the immediate economic impact is actually going to be more positive. That we could get a really quite a sharp rebound in spending. Retail sales on goods exceeds where it was at the end of 2019. Retail sales on services does not, but that will come back once the vaccine is, you know, it may take 3 to 6 months. So I would look at a very positive economic environment Someone mentioned two halves for next year. I actually think the first half, I mean, it won't be very pleasant, but it won't be disastrous. We've been through it. The lockdowns are much more targeted, and we could get a very strong rebound in the second half. So, and looking forward, I do think there's an issue of you could get a big boost in production without a commensurate boost in employment. And so we're going to have this whole challenge going. This is going to be a sort of, if you like, a jobless recovery.
I think I'd just add to what RockCreek has said about this divergence between the market and the economy. There's also a K-shaped explanation of the market, of course, because the stocks which have done fantastically have been the big ones, and the e-commerce ones, the Amazons of this world, and Facebook and Netflix and so forth. They have done fantastically, and that's been supported by earnings, which itself has been supported by all of us being locked down. So it's perfectly consistent. The rest of the market has not actually done very well, and that's pretty consistent too, since a lot of it's shut down and airlines aren't working and so forth. I think I'd just add one more comment about the next year. I think one of the things to watch is when international travel begins to open up. And that won't really open up well until we have both vaccines and a good testing protocol. I think it'll open up first within regions in the EU, and I would include Britain in this. Maybe that's optimistic, but I think we'll get our act together on opening borders and reducing quarantines when you cross borders. In the US, I leave that to others to think about, but in Asia, that's already beginning to happen within Asia. And that will change supply lines. That will really accelerate intra-regional trade, but it may be quite a long time before global trade really recovers because of this issue of international travel.
Can I ask the following question? Has the Fed has been unusually committed, and this whole new sort of framework they've established, where they've said, even if inflation starts going up, we are not going to tighten. And the thing they've almost admitted that they made a mistake 2 years ago or 3 years ago, whenever it was, when they started tightening. And they're basically saying, that was the wrong thing to do, that we should just keep interest rates at zero, not only, until unemployment disappears. And it doesn't matter if inflation goes up a bit.
Liquid, I want to add one thing to your question, because I think my reading of what they said is the same as yours, but it's not just the unemployment issue. Is they are basically saying that the standard measure of labor market tightness, which is the unemployment rate, is wrong. It's misleading. We actually have to look at unemployment rates by ethnic group, by skill level. We need to have a much more nuanced version of how we measure capacity fulfillment. So,
yeah, I think that's right. And it was quite unusual to see the Fed talking about inequity and those issues. But I think that we learned kind of over again that running the economy hot, or at least gradually allowing it to warm up and become hot at the end of 2019 and January of this year, really pulled people into the labor force who had been out for a long time. And that seems to be, we can do training, and we should. We can do specifically targeted programs, but macro policy is the most powerful way to get jobs for people.
What is going to positively surprise us in 2021? A positive surprise. We need something good.
Well, I think the positive surprise is that we get, I don't know, four vaccines, and everyone's vaccinated by June, and that I think would just that would be transformative.
Super.
everyone in the West.
The best thing would be to get rid of COVID-19. But I think another very positive push would be, I don't know how likely it is, but if we had a successful coming together of the major economies in the G20 around an important agenda that included jobs and equality, climate action, and guidance for the next pandemic.
The big surprise would be if all of these things actually happen in the spring. You know, the virus kind of weakens in the spring. Meanwhile, a lot of people have been vaccinated by then. The new Biden administration has shown that it's not just competent, but actually, you know, gets things done in a better way than we've seen in a long time. And Britain finds that actually being outside Europe is just fine.
I hope basically it's the most optimistic outlook for this year is we get through enough vaccination of the population that we can resume in the advanced industrial countries at least travel. And I do agree with Liquette that if we do that, we are set in place for a strong recovery. I do therefore worry about it doesn't mean a strong employment recovery, but the surprise, it's not even a surprise quite, it's my hope is that that's the scenario for this year. It shouldn't be a surprise, but we're just starting the process now. So
I think a lot of you will be involved in a lot of the changes that are being made in the UK, in the US, and let me thank you for taking part in our meeting today. And look forward to our next conversation, and best wishes for the holidays and hoping for a better world in 2021.